Jeremy Siegel, professor of finance at the University of Pennsylvania. Jeremy, things had been moving along in a lot of the right directions. Equities, of course, had been on quite a streak. Things are now turning around in large part on the back of this inflation data and the expectations for the Fed. I'm so curious what your reaction to that inflation data was yesterday and how you think Jay Powell is going to handle it.
Yeah, I think as Mike said in the 6 a.m. hour, if the data came in yesterday just 2 or 3 hundredths of 1% lower, it would have rounded exactly to the expectations of the market. It sort of reminded me of what happened after the last FOMC meeting. If one of the 19 FOMC members had raised by 1 tick their December estimate, we would have had a median of only 2 increases instead of 3. Probably the market would have collapsed, but because they did, it said 3 and the market soared. It's so hypersensitive, overly sensitive to these numbers. Let me just read 2 sentences from the BLS report that came out yesterday. After reporting, they said the shelter index increased 5.7% over the last year, accounting for over 60% of the total 12-month increase. Other indexes with notable increases include, and we've talked about this, motor vehicle insurance up 22.2%. Well, the shelter and motor vehicle insurance are the 2 most backward-looking of all the components of the consumer price index. If you take, for instance, on-the-ground indexes such as the Zillow index, or particularly the apartment list index, which has an excellent index of monthly rentals, it's actually been 0 year over year. In fact, it's been 0 year over year for almost 2 years. We've talked a lot about the way the BLS does it. It's an 18-month moving average that way lags the market. You take auto insurance. It's verified that auto insurance premiums follow 12 to 15 months after the increases in used and new car prices. Well, they all rose during the pandemic.
In other words, are you suggesting that we are overstating or overthinking maybe?
Yeah, you're overstating.
The inflationary pressure on the economy?
Yeah, I think they're overstating and overthinking. Now, all that said, commodity prices have stopped going down. There's no question that we're seeing some rise in commodity prices that we hadn't seen for 2 years. And that's something to look at. And by the way, the money supply, which I looked at, is finally beginning to rise again after, being really flat for so long. So that, these things bear watching. But hey, I just think that there was an overreaction to what we actually got. And I really think that inflation is still going down to the Fed target, and that we might see, I said 2 rate cuts. I never thought 3. 2 rate cuts by the end of the year. But more important than that, and if you were to give me the choice, rate cuts or strong economy, it's no contest. Strong economy is better for the stock market.
I want to start with AI because it seems to be the buzzword of everything. When we were here last year, we were talking about AI, but it was unclear, I think, completely where Amazon was going to play in this AI world. And you now say it is going to change everything and that you have really almost shifted the whole company towards AI in almost every space now.
Yeah, well, we've been saying it for a while, and I do think that AI is going to transform every customer experience that we know. And, I think a lot of the discussion has been around applications and starting really with ChatGPT, which really caught people's attention. But we think there are 3 big macro areas of the generative AI stack, each of which are gigantic and each of which we're investing deeply in. And, I think of it as at the lowest layer are for people that are building their own large language models. And the 2 things that really matter there is the compute to train the model and to run the predictions of the inferences. And what matters in that is the chip. Right. And then the services that you have to actually build models. And we've got very significant investments there. Most of the early AI models have been built by NVIDIA, but supply is more scarce, and people are concerned about cost. And so we've built our own custom silicon in AI. We've built a training chip called Trainium and an inference chip called Inferentia that are meaningfully more price performant than what you can find out there. So a lot of the training, a lot of the predictions are going to be done on those chips. And, and then I would say at that middle layer of the stack are for people that are going to actually leverage somebody else's model, but customize it with their own data and then use our features to make it easy as a service. And we built the service called Bedrock. And a lot of the generative AI applications are being built on top of Bedrock because it's the easiest way to build a high-quality generative AI application. Then there's the applications, of which we're building a lot of them ourselves, but the vast majority of those will be built by third parties, and we're optimistic a lot of them will be built on AWS.
Let me ask you about this. Let's talk about large language models, because there's just so much focus on it. You have now made investments in Anthropic, which Google has also made an investment in. You're building your own large language model called Olympus. How are you thinking about investing in things like an Anthropic versus trying to build your own?
Well, I think the one thing that we've seen pretty consistently in this relatively early stage of generative AI is that customers want choice. They're learning how to build models. They want different model types for different types of applications and use cases. They want different model sizes because it changes the latency and the cost structure. And so, part of the attraction for so many people of Bedrock, I was just mentioning, is just it has the largest selection of models available. It's got not only models that we build, but also Anthropic and Meta with Llama 2 and Mistral and Cohere and Stability AI. So you have a lot of choices. And then Bedrock makes it really simple to move between models and move between model sizes so that you can actually experiment and get the right quality and latency. We're going to, for us, and we see it with our own, we're building dozens of generative AI applications right now, some of which are launched, others are in development. We find it with our own model builders and our own application builders that sometimes they want to use our own models, sometimes they want to use third-party models, and we're going to give people choice so they can make those decisions.
How important, though, is it for you to catch up on having your own generative AI large language model? Meaning this Olympus project, which has been reported on, how important is that? How far behind do you think you are? What do you have to do to get that to the same level as where Anthropic may very well be or where you believe OpenAI is today?
Well, I mean, first of all, what I would tell you is that this is going to transform virtually every experience we know. It's a gigantic space, and there are going to be a lot of very successful players in it. And if you go talk to enterprises or companies that are using generative AI, they are very excited about what we're building, and more customers are moving to our services. And we're going to have partnerships. We have a very deep partnership with Anthropic. Claude 3, which they released just a few weeks ago, is the best model on the planet right now with the best performance, and it runs, best on top of AWS. And so our customers are very excited about that. But at the same time, we have a lot of experience building models at the company. We've been doing it for a long time, and we've been building our own models, and these Titan models we have, we're going to keep building those, and we're going to give people choice.
Economists are calling into question whether the Fed will be able to lower rates anytime soon after a third month of higher than expected inflation readings. Our next guest says that there is no room for a Fed cut in June or quite possibly this year. Joining us right now is former Council of Economic Advisors Chairman Jason Furman. He is a professor at Harvard's Kennedy School of Government. And Jason, we were reading your tweets because you were a pretty active tweeter yesterday. We were reading, or Xer, I should say. We were reading your X's as you were doing this kind of real time on your reaction to what happened with the CPI number. I mean, you're of the opinion now that there's basically no way they can cut anytime soon.
Yeah, look, Becky, I had allowed myself to get optimistic a couple months ago. But, fool me once, shame on you. Fool me twice, shame on me. We've now had 3 months in a row of prints coming in above just about what everyone expected. It's time to change the way we think about things going forward. The market has done that for June, but continues to hold out hope. I'd love the Fed to be in a position to cut rates later this year, but the data is just not close to being there, at least yet.
What's so concerning to you in the inflation numbers? Because we have a lot of people who will look at it and be able to argue it away. We just had Professor Siegel, who was on with us, Jeremy Siegel from UPenn, who was saying, look, a lot of this is backward looking. This is stuff that we knew was out there. These are late things that we know are going to be after 12 to 15 months when you've got things like car insurance that go up. You have other people who, a city analyst or a city economist we had on yesterday who said, and it was still saying the same thing after the numbers, that, hey, it looks like the jobs market could be on the verge of the turnover if you look at small businesses. What do you see that they don't?
You know, the first thing I'd say is you can take the inflation numbers and slice and dice them lots of different ways. And if what you do is take out everything that has unusually large increases and assume all the decreases continue, you're always going to think inflation is going to get better. And that's a mistake I've seen people make over and over and over again. The systematic ways of dropping the extremes on both ends. And when you drop the extremes on both ends, the inflation picture, if anything, looks a little bit worse than what the headlines are. The other thing is, you know, sure, this stuff is lagged, but core inflation on a 3-month basis has gone from below 3 to 4.6% over the last 6 months. It's actually rising. And, you know, none of these lag stories give you why it should be rising. It should still be falling. Now, look, do I think we're at 4.5% inflation world? Absolutely not. What the Fed targets is lower than that. I don't think it's a moment for panic, but really not a moment for complacency either.
Jason, we probably are guilty of talking about the inflation numbers a little bit too much strictly in the context of, therefore, what will the Fed do? I think everyone agrees it's fine to wait for a potential Fed rate cut if it means that we have to let inflation settle back a little bit more. It's more about the potential adverse results, if there are going to be any, of the Fed staying tight. So what's your theory of the case? Do we actually have to have unemployment go up more? Do we have to have the service economy slow a lot more in order to get inflation down? Or can we somehow just wait and have time take care of it?
Yeah. So first of all, the thing to understand is even if the Fed doesn't move rates, financial conditions are easier now than they were a year ago. Now, they got a bit less easy yesterday as the expectation for what the Fed was going to do shifts. And if that expectation shifts more, they'll tighten even more. But financial conditions are just not especially tight right now. In terms of what it will take for the last mile of inflation, I had long worried that the last mile of inflation would be the hardest. There's a lot of evidence for a nonlinearity in the disinflation process. If that's the case, you would require a decent amount of unemployment to get inflation all the way to 2.0%. This is where I turn dovish. I don't think the Fed needs to get to 2.0% inflation. At a minimum, I think getting to something that rounds to 2% inflation would be just fine. 2.49 rounds to 2. If it's stabilized there, I don't think anyone would notice it. I don't think they can tolerate a risk of inflation above 3, though. And that's the risk that we're facing.
Former Fed Vice Chair and a CNBC contributor. Roger, let's talk through this because you have been very right for a long time, and you've also been highly skeptical of the idea that these cuts could come very soon. What did you think after yesterday's number?
Well, I thought a couple of things. One, in some ways, it's unfortunate that the inflation is still running a little hotter than the Fed would like, because, as we know, inflation is a drag and a tax on many individuals. Secondly, I think the commentary from the Fed, I think, had been pushing towards this notion of no rush to cut. We heard from President Bostic possibly only one cut. So I think this, in some sense, supports that side of the commentary. And finally, I think the market was right to simply take the June rate cut probably very much off the table, and now we're looking, much later into the year for the first rate cut, if any, occurs this year.
Yeah, the market yesterday didn't just take the June rate cut off the table; it took the July cut off, and people are thinking it's going to be a pretty long, hot summer. I think you're already of that opinion. This just solidified it for you.
Absolutely. Look, the good news here is that the economy is doing very well. I think the truth is, we aren't really sure, policymakers, economists overall, exactly how restrictive monetary policy is. Because if it were so restrictive, you would have seen things slow down much more than they have thus far. And so the challenge for all of us, Becky, is post-pandemic, all the changes that are occurring in the economy, so older folks leaving the workforce maybe, changes in how people work. All of that is leading to uncertainty about how inflation dynamics work. And that is paying through in the inability to be really accurate about the inflation call, and therefore, the inability to be really prescriptive and accurate about what the next move is going to be on rates.
There are a number of doves and dovish outlooks out there, Roger, who are able to look at this number and say, well, this number doesn't really take things into account. When you get the CPE number, that's going to show us something different. I'm sorry, the PCE, that's going to show us something different. A lot of these numbers are backward looking. These are things we knew would be lagging indicators. What do you say to all that commentary?
Yes, first, the PCE has been somewhat lower, which is, I think, net good news. And that helps the Fed a little bit, and it's a patient story. I'm always careful to sort of exclude the things that you don't like. When you start to say, well, you take this one out, you take that out, you can certainly look at this in a more optimistic way if you want. I think that's unrealistic, because if you talk to individuals, what they are feeling is continued pricing pressure. And so I think we should take this relatively at face value. Yes, there are ways to cut it, but I think that leads to a very dangerous situation that we've seen long ago. When you start to ignore the bad parts of the inflation number, you get to a place where the Fed is falling further and further behind the curve. That is not a good idea. So I take this at face value. I do take some comfort that the PC is somewhat lower, but I think the Fed is right to hold off on starting any cuts until they gain higher and stronger confidence that inflation is really coming down closer to that 2% target.
Let's talk about the banks, because they do kick off earnings season officially, Shan, tomorrow. I mentioned some of the damage in that space. Month to date, the stocks have all not performed very well. This sector was one of the better ones over the last, 5 weeks. Have things turned because of rates?
I mean, I think there's some concerns around that. I mean, if you look at the banks, they have been beset by continuing increasing provisions for credit losses, slow loan growth that Josh talked about earlier. And there has been an expectation that, and there's been a wide divergence, right, between the big banks and the regionals. And obviously that's been in place since early 2023 with everything we've seen in the regional banks. But I think that this is a second half story, Scott. And so, but to put a point on it, estimates have already been revised down for the big banks for 2024 by 10%, for the regionals by almost 25%. So you're not coming into this with these really constructive viewpoints on banks for earnings this year. And so while this near-term overhang from this, changing rate environment, whether it's June, July, or September, there's some of that has already been priced in just from the low expectations that are being set. What you could see coming up over the next few days is that you could see no major credit surprises. You could see, maybe like modestly increasing loan growth. And for the big banks, you've got investment banking and wealth management certainly are going to look better in the second half of the year.
If we're focusing on the biggest banks, why do you think it's a second half story?
Because I think that they are expecting that they will get that rate lift from a net interest income perspective in the second half of the year. And so they're going to guide for better results in their true banking segment in the second half of the year. Also, there's an anticipation that capital market activity is also going to pick up in the second half of the year based on the fact that we're seeing, a foundationally stronger environment for equity issuance.
Rich, so if I own the JPMs, Goldmans, and Bank of Americas as you do, how am I supposed to feel about this space today as it's suffered, as I said, some, technical damage below its 50-day for the first time, the XLF is since November, but also some questions now. If rates are going to remain higher for longer, delinquencies go up, charge-offs, all that kind of stuff to be concerned about, do I need to rethink the financials trade?
Well, years ago, when Reagan was president, you used to be able to buy this industry below book value, and you sold it at 1.5, 2 times book value. Today, Bank of America's 1.5 times book, JP's 2.2 times book. Their return on capital is 11, 12%. So they're doing well. They're expensive. But keep in mind, Bank of America had $130 billion of unrealized losses on their balance sheet in their hold-to-maturity portfolio. That's now down to $100 billion. So would I be adding them here? Probably not. Are we holding them? Yes, we are.
You in that camp? I mean, you love J.P. Morgan better than all of those banks because that's the one I think that you own, the only one, right?
I don't feel the need to own the group broadly. if they work, JP Morgan will be among the better performers. And if they don't work, well, then I don't have to wake up and be like, oh my God, do I literally own Wells Fargo? Like, I don't have to have that. I don't have to have that conversation with myself. So that's where I am. Look, JP Morgan is going to do $4.15 a share, according to consensus. That's not a huge jump over the prior year, but it ain't nothing either. Quarterly revenue, $41.96 billion, and that's versus $39 billion in the year ago quarter. So I mentioned nominal growth that we would see from the banks. That's what I mean. It's not like all of a sudden banking is an amazing business. It's just that it was so bad in 22 and coming out of that in 23, and now you've got a better environment overall. JP Morgan trades at a premium, which Rich mentions, but I would argue with good damn reason, 22% CAGR on earnings per share growth in the last 3 years. None of the other names can say that. 13% over the last 5 years, so that's not just a recent phenomenon. I expect JP Morgan to have a good quarter. I remain long the stock. I think it's worth more than $200 a share. I like the fact that it's down, a little bit of a gift here.